Good morning, viewers, and welcome to the channel. My name is Shannon Rivkin. This week's video is covering oil and in particular, two biggest pure play oil companies in Australia. The title is With a Bright Outlook for Oil Prices, How Will This Impact Woodside and Santos? So I've got just a chart of crude oil since 2015, which showed the previous run above $100 a barrel, and then, of course, that incredible drop. Actually, I think this is using futures, sorry. Anyway, below zero at least futures, and then subsequently up above 100 again. The story, of course, being, well, a few major factors, but one, underinvestment in oil developments as economies and governments move to decarbonize, and of course, in the immediate near term, the conflict in Ukraine, and the sanctions on Russia, which is putting an even more challenging slant on supply in the near term. And of course, as economies recover from the pandemic, as demand for energy increases, that supply side just hasn't been able to keep up. And realistically, it's hard to see how that is going to abate in the near term. I've made the argument that I feel like Western governments have made a political decision that sanctioning Russia is in their best interest, and I don't think that's going to be undone, even if the war there ends anytime soon, or even Putin walks away. I think that probably a change in government is the only way that you see those sanctions unwind in a real hurry. So, with Russia being obviously a huge supplier of oil and gas throughout the world. For example, provide 40% of natural gas to Germany. And while Germany have limited their sanctions, at least on oil and gas, it's very hard to see how that could be replaced, at least in the short term. Of course, many people out there are suggesting that this should accelerate the move to renewable energy. But the problem is, of course, in the short term that the technology is just not there yet. It's going to take many years to fill that gap. So prices are going to go higher, and there's no way around that. Anyway, this is a chart of Woodside and Santos. Interesting to note that really between 2015 and 2019, kind of all stayed within a pretty tight range. You both paid consistent dividends. Then, of course, when COVID came, they sold off pretty aggressively. Well, Woodside even went as low as 15, and Santos, I can't remember the low, but it's I think 250 or something like that. And really, at least in the early days, when of the pandemic recovery, as there were still restrictions around the world, but oil prices recovered. You started to see Woodside and Santos really underperform. Actually, I should show that here in the next chart. And this is a percentage return since 2015. So yeah, kind of when the pandemic started here, saw a significant drop in crude, but again, I think that's futures. But while they both sold off aggressively the equities in Woodside and Santos, the recovery was a lot shallower, and the reason for that, I think, well, at least in my view, that what the reason is that the pandemic has accelerated ESG as an investment criteria. It's the first thing that investors and lenders and all stakeholders really mention these days is ESG, and coal has certainly got that ESG discount, and oil and gas has had it too. And only now we're starting to see Woodside and Santos kind of play catch up to crude. And I think to some degree, and I've heard this argument made, and I think there's some merit to it, given that renewables just can't fill the gap just yet. We need to start looking at some of these companies that are being responsible and that they are trying to move to zero carbon output eventually. But in the meantime, we obviously need energy security as well. So these companies, at least the ones who are at least making active moves to decarbonize. Santos is one that I read is probably ahead of the curve, at least in Australia, in moving to net zero. That these should actually be not perceived as ESG issued investments, but rather actually part of the solution. It's certainly it's a positive way to look at it, but I think there's some merit to it as well. But you know, in the near term at least, even if these companies do continue to get that ESG discount, this is, I think, the major factor here. Knowing that these companies know the future of oil and gas, know that at least in 10 or 15 years, when renewables have replaced much of that demand, or rather, at least provided a supply to match that demand. Um, you know, and are going to expect lower oil prices rather than commit to, you know, more and more, you know, projects that are going to be more questionable on lower oil prices. I think that dividend yield is going to start to kick up and kick up even further. So just it's almost hard to ignore these oil stocks in the short term based simply on dividend plays. We've seen the dividend yields now in 2020, or at least because that was, of course, a trailing dividend when the stocks fell, the trailing dividend yield got so high. And this one we've seen the first new increase in dividend, which I think is on Woodside Petroleum. And I think we're going to see that with Santos too. So I think if you kick this further out, going into the mid decade, these dividend yields should exceed 10% consistently. And I think therefore at those levels, it's hard to say that these aren't good buying opportunities, even if of course they do have their issues when considering ESG factors. But every asset obviously has a price, and if you can ignore the ethical um, dilemma in buying. And of course, there is, as I mentioned, a good ethical argument to say that as transition energy security opportunities, they shouldn't be ignored on an ESG basis. Then on value alone, they look very cheap. Anyway, that's it for this week's video. Thanks for tuning in, and I will be back next week with a new video. Oh, and I should say, if you like the video, please click like and subscribe.